For those just joining, you can scan the QR code to join our poll and submit any questions for the Q&A later. Okay, folks, we'll just give it one more minute for those still joining. You can scan the QR code to join our poll if you haven't yet, and you can also submit some questions for our Q&A at the end of the session. Okay, so we can kick off. So I'm Aman Pujara. I'm part of the investment team here at syfe. It's fantastic to be here with you all today. Let's start by jumping into that poll. So the first question, how long have you been investing with syfe? Are you new in your syfe journey, less than 6 months, or have you been with us for more than 3 years? Looks like quite a mix. It's nice to see a number of new clients with us today, but the vast majority of you have been with us for more than 3 years. That's fantastic to see you continuing to stay with us. Fun fact, I was a client of syfe long before I joined. Okay, move on to the next question. Now, there's a pretty strong consensus here. What is your main goal for investing in syfe portfolios? Long-term wealth growth is by far the winning answer here. Some of you looking at passive income, capital preservation, and diversification beyond your stock portfolio. Okay, no, that's fantastic, and we're going to see later on just how our managed portfolios very much are geared for long-term growth with disciplined approach. Let's move on to the next question. And so, what do you like most about the syfe platform? That it's an all-in-one platform. You can invest, trade, and save in one place. It's user-friendly, the low fees, diverse investment options, or the reliable customer and advisory support. Okay, so far it looks like most people are enjoying the fact that they can just come to one app for all their investment needs. It's very handy. With that, we'll close the poll. You can continue using this link to submit your questions for the Q&A later. We'll flash the link again later on. So why are we all here this evening? Let me walk you through the agenda. So after this short introduction, I'm going to walk through the managed portfolios outperformance in 2024. We're going to dig into the details of how the performance looked over various periods and how that was achieved. After that, Ritesh, who I'll introduce shortly, is going to walk us through the 2025 market outlook and portfolio positioning, looking ahead. before we close with that Q&A session where you'll have that opportunity to ask any of the questions that may be on your mind that we've not covered in the presentation. And we look forward to that being an engaging end to the evening. Now, without further ado, I'm delighted to be joined by Ritesh this evening. Amanta, many of you won't need an introduction, but for those of you new to syfe, Ritesh heads up investment and advisory at syfe. He's been part of the team from very early on in syfe's journey, and so he's been pivotal in the development and evolution of the investment product suite. Ritesh, do you have some words before we kick off?
Yeah, man, pleasure to be here. Looking forward to the session today and sharing insights about the markets.
Thanks, Ritesh. Myself, I mentioned earlier, I'm part of the investment team here at syfe. I look after the portfolio construction and quantitative research here at syfe. Before that, I was working in a couple of different financial institutions here in Singapore, and before that, London, in case you haven't guessed yet. Okay, so for the benefit of those joining us for the first time, around a third of the folks on the poll were still less than 6 months into their syfe journey. We're going to do a very quick introduction on syfe. We're an all-in-one investment platform that takes a mobile-first approach. What that means is in our app, you can access managed portfolios, your cash management, as well as the brokerage platform, all accessible in the same app, allowing you to invest in a holistic manner. On the next slide, we'll walk through a quick timeline of the firm's rapid growth in just 5 years. So syfe was launched in 2019 in Singapore. It's where we're still headquartered. We have had a number of key milestones along the way. I think I'll highlight in particular just how significant last year was for us. We completed our most recent funding round, but on top of that, we also launched our protected portfolios and SRS solutions in the same year. So now on to managed portfolios. And on the next slide, we'll start with our key overall investment principles. And these we apply to all of our managed portfolios, namely diversification, cost effectiveness, and a long-term focus. Now, what this means is we're looking to provide global, broad portfolios across various different countries, sectors, asset classes, in the most cost-efficient manner, scrutinizing fees, ensuring those are transparent to clients, and that there's no hidden trailer fees or kickbacks. Our managed portfolios take a long-term view, and I'm glad to see in the second question in the poll just how important that was to all of you. These portfolios are focused on a disciplined long-term process and focus on returns. On the next slide, we can take a quick high-level view at our suite of products. Now, for short-term funds, we have our savings pillar. This is where our cash management solutions sit. You can get between 3.4 to 4.3% yield on your spare cash, your funds that you're not able to invest anywhere for the longer term. Now, if you're looking for higher yield and a slightly longer term view, we have our income pillar. Now, in our income or yield pillar, we have Income Plus portfolio we'll talk more about later on. This was launched in partnership with PIMCO, a global leader in active fixed income. This portfolio has two flavors, and it provides a monthly payout. Similarly, in the same pillar, we have REIT Plus. Again, we'll go into more detail on both of these portfolios later on. This is a very efficient way for you to invest in real estate within Singapore. This was launched in collaboration with the Singapore Exchange. Again, there's two different flavors, and we have an estimated dividend yield of above 6% for this portfolio. Both of these we're going to cover in a lot more detail later on. We also have growth-based portfolios for those clients who are more focused on longer term growth and want to grow those assets. We have our core, our flagship managed portfolios. These portfolios have four particular risk tolerances catered to each individual need. These portfolios consist of global equities, bonds, and gold. And we have portfolios all the way from defensive, which is mostly bonds, through to an equity 100 portfolio, one of our most popular portfolios, which is 100% equities, designed for the biggest growth out of these. We have specialized portfolios. So I mentioned we launched our downside protected portfolios last year, and we also have a number of thematic portfolios. And again, we'll dive into the details on those later on. For those who want to select the stocks they invest in themselves and ETFs, we also have Syfe Trade, which has access to the US, Singapore, and Hong Kong stock exchanges. Now, diving into the core portfolio's performance, I'm delighted to share with you that all of our core portfolios and indeed all of our managed portfolios outperformed their benchmarks in 2024. Now, in this particular slide, we're looking at the performance over the whole year across the four different portfolios from Equity 100 on the far left, which also is available with our SRS solution, which is why you see an extra bar there. The performance there is around 22%, eclipsing our benchmark. Now, as we move across the risk spectrum into our multi-asset portfolios in core growth, core balanced, and core defensive, you can see significant outperformance there of up to 3% on the year itself. And we'll go into a little more detail later as to how we've achieved that. Next slide, please. Now, we often get asked how we're different to our peers. It's one of the questions we get most often, whether it's from clients, family, friends. I think the key thing that we focus on really here is our process, our disciplined, systematic, data-driven investment process. We don't want to be constructing portfolios based off of static and fixed allocations. We dynamically allocate to the various asset classes based on their risk forecasts that we have calculated internally using our risk engine. And that ensures that we can continue adding value and enhancing outcomes for our clients. We're going to go into a little more detail as to the various enhancements we've made along the way. In particular, on the next slide, we can summarize some of the key changes we made last year. Now, you may recall last year we made a significant number of upgrades to our core portfolios across three main areas. Firstly, in the equity sleeve, we placed a greater emphasis on size, value, and quality factors. Now, if you don't know what factors are, you can check out our website or our YouTube channel, which has descriptions that can help you understand what they are. Essentially, they're some of the key drivers of long-term returns in the stock market. When it comes to bonds, we've optimized our allocations last year, both from a broad bond market exposure, shortening duration, but also introducing corporate bonds, both investment grade and high yield. Now, across both equities and fixed income, we made a significant improvement in our tax efficiency. We made strategic shifts to UCITS ETFs where that made sense, taking into account costs, spreads, liquidity. It's not always an obvious switch, and up to and over, in fact, 40% of all of our core portfolios now are in UCITS ETFs. Now we can take a deeper dive into understanding these particular enhancements, how they've benefited and driven additional returns in our portfolios. So here we have the core equity 100 performance since we've implemented those upgrades. On the far left, we have the original portfolio, and on the far right, we have the performance of the revamped portfolio. In between, we can see the drivers of the increased performance there. The factor enhancements for the equity piece included adding exposure to small and mid caps through DFAT, one of the dimensional um, fund advisors ETFs that targets small value and high profitability or quality names, as well as an overlay of value and quality we added through Moat, provided by Vanek. Now, these particular factors have shown over the long term to drive outperformance in portfolios and superior returns with that long-term focus in mind. On the next slide, we can see how these upgrades looked for our multi-asset portfolios. So again, on the far left, we have the original portfolio. On the far right, we have the revamped portfolio. Now, our core balanced portfolio is a mix of equities, bonds, and gold. The equity impact here is the same as the enhancements we just discussed. It's simply smaller because equities is just one portion of this portfolio. Now, if we look at bonds, that's where the real meat of the improvement is here. And a big part of that is around the tax efficiencies, but also the introduction of the corporate bonds in both investment grade and high yield. We've seen a significant take up in additional returns there. Of course, the tax advantages and efficiencies being that much more important on the fixed income side. Now, the gold impact here is simply because gold has had a stellar year through 2024. As a result, when we made these upgrades, we needed to reduce our allocation there from a risk perspective, and it continued to rise. So nothing out of the ordinary there. We're comfortable with how this is. On to the next slide, please. Now we've talked about concentration risk a lot. It's something we think is incredibly important and one of the key or easiest mistakes perhaps to make when it comes to investment. It always surprises me when I speak to family or friends personally around investments and the understanding or awareness of how concentrated something like the S&P 500 actually is. So let's walk through a recent case study. I'm sure the news articles and the companies involved need no introduction. But on the 27th of January, obviously some week or so after DeepSeek launched their model, there was a big stock sell-off, particularly of course for Nvidia, who lost almost 17% on that day. Now, in the bottom right of this chart, what we're looking at is the one-day returns of various different references here on that particular day. Of course, Nvidia took the brunt of that sell-off, recording the largest ever market cap loss for a stock in history. But as we look at both the technology indices, Nasdaq 100, the Mag 7, and then the S&P 500, you can see the losses slowly decrease. One of the key pillars for us, and in fact you see it here, is the core equity 100 just lost 1% on this particular day, which was one of the biggest sell-offs. Now, how did we do this, or what does this actually look like when we talk about concentration risk? That's on the left-hand side of this chart. So if we think about how much of the holdings of any of these particular portfolios or indices is in the top 10. The S&P 500, for example, an index of 500 companies, the top 10 companies make up more than 36% of that index. It's for only 10 out of 500 names. It's still something that I think a lot of people need to understand the importance of that and the risk with that. Even a broad world index, it somewhat reduces that top 10 exposure, but it's still high with the MSCI All Country World Index. With our core equity 100 portfolio, we further reduce that exposure of the top 10, and that's through our diversification pillar. And that's really important, which leads to outcomes like this, where you see some cushioning from the significant market swings that we will experience in our time in the market. Next slide, please. So now we'll talk about our income plus portfolios. There's two flavors of this that we launched, and they're powered by PIMCO, a global leader in fixed income, which is very important when it comes to putting together these portfolios in an asset class like fixed income. The performance can be seen here, and I'm delighted to present to you that once again in 2024, as we did in 2023, we've outperformed the benchmarks. So what we can see here is the two different flavors of income plus, both preserve and enhance, which are yielding between 5 and 6% in monthly payouts. Now for 2024, the broad global bond market in SGD terms returned only 1.5%. These two portfolios returned quite in excess over that, as you can see in the 2024 column, as they did in the year beforehand as well. This outperformance was driven by PIMCO's active management. Again, this is something crucial in the bond space. In particular, strategic exposure to emerging markets, corporate and securitized credit. Next slide, please. Now, what we want to always ensure we're doing is we're providing portfolios and products that do what they're designed to do. When we tell you the distribution that you can expect from these portfolios, it's important to us that is the distributions that you're going to be getting. So here we look at the monthly distributions over time, and of course those ranges that we indicate vary over time, and we update those. As you can see, both the enhance and preserve portfolios are delivering within the ranges that we've shared. And in fact, what we highlight here is some of the ongoing enhancements that we've worked on with PIMCO. In June of last year, we made some optimizations, particularly to the preserve portfolio, to bring up that monthly yield, and you can see that very clearly circled on this chart. Go to the next slide, please. Now, REIT Plus is our portfolio that provides very efficient access to Singapore's largest REITs. We launched this in collaboration with the Singapore Exchange, and it tracks the iEdge S-REIT Leaders Index, but with our own methodology, and we'll come into that in a little more detail. Now, on the next slide, we can see that 2024 was another challenging year for REITs. It was a roller coaster year, actually, for the market. This is a asset class that is heavily impacted by macro factors. And so despite rallying 20% in Q3, the sector as a whole gave back most of those gains by the end of the year. Now, I think it's really important to look at the context here, particularly with this portfolio. It's been challenged by, particularly last year, higher rates, a stronger Singapore dollar, and in fact, Ritesh is going to take us through in a little more detail later on why we can see that in 2024's various macro impacts, but what we expect and what we're looking at from a future perspective. So Ritesh will cover that in a lot more detail later on. One positive aspect, though, for this particular portfolio, it's continued to outperform the methodology we put together that filters through the REITs available to us, looks into liquidity and various other aspects, has meant that we've continued to outperform not only in 2024, but in fact since inception, which you can see in the next slide. This just gives you an idea of the consistency in the outperformance from the methodology that we've put together here. And despite some challenges in the market, these outperformances as we go forward will continue to be there. Um, Again, Ritesh is going to cover a bit more about our outlook for REITs later on tonight. Finally, we come to our specialized portfolios. Now, as I mentioned before, we've launched last year our downside protected portfolios. What these portfolios do is they allow you to capture some of the upside of the S&P 500, but it will also cap your losses against significant downside moves. So let's take a look at that in a little more detail. Here we've shown the performance of this portfolio since inception, which was at the end of July last year. We can see it was 4.5%. And now underneath we've given some reference assets. Obviously, the S&P 500 index is the key reference asset for us that we're trying to reduce risk against. But we also provide the US bond index there for color. Now, the key thing here is this final column, the maximum drawdown, the biggest reduction these portfolios have seen over this particular time period. Now, as we can see for the downside protected portfolio, that reduction was 1.8%. For the S&P 500 index over the same time period, it saw an 8.5% drawdown. Now, in the next slide, we can see that was during early August when recession fears were there. But I think this chart highlights quite nicely the smoother ride that this portfolio is providing you with, again, doing what it's designed to do. In blue, we have the downside protected portfolio's performance over the time period in which it's been launched. In the solid gray, you can see the S&P 500 index, and in the dashed gray, you can see the bond index. Now, look particularly in August and September, some of the very significant drawdowns that you see in the S&P 500, these very much have been smoothened out and dampened with this portfolio. So for those folks who are looking for something a little more protected in nature for some of these drawdowns, this new portfolio we launched only last year, I think is a fantastic option for you. Now, we also have a number of thematic portfolios that can be used as satellites to your core portfolios. Now, disruptive technology has had a stellar year. We've all been following along on how AI has been developing in the broader world and the use cases continuing to come out there. As part of our upgrades last year, we've increased our exposures to generative AI, semiconductors, and of course, blockchain still remains a key part of this portfolio. Now, ESG and clean energy and healthcare, those particular portfolios and sectors have had a muted performance last year. And the reason for that is very similar between the two of them. There's been significant policy shifts through the Trump post-election presidency, and that's dampened the near-term momentum on these particular portfolios. The long-term growth prospects, though, remain intact, and indeed we've continued to enhance these portfolios in ESG. We've added more renewable energy leaders and EV or battery companies, and within healthcare, we're looking at innovative companies that look at medical robotics, digital health, and telemedicine. Now, I'll try not to steal too much of Ritesh's thunder when it comes to covering China, because he has a few slides on it for later on. China saw a late year rally, and there's still plenty to come there. Notably, for us, we've added exposure to the STAR market, which is a specialized venue that takes some of the hottest domestic IPOs in leading tech and innovative companies. Now, Ritesh is going to go into a lot more detail on China there. So, without further ado, I'll hand over to Ritesh for the broader market outlook and portfolio positioning.
Hello. Hey, Aman. Thanks for covering the portfolio performances. Let me just, yes. Hi. Hi, everyone. Great coverage, Aman, for the portfolio performances. Obviously, a stellar year across our different portfolio offerings, with the exception of REITs, which, were impacted by the, broader macroeconomic landscape, right? But let's do a quick recap of 2024 before I start covering 2025 and how clients can start positioning their portfolios as well. So obviously 2024 began with whispers of recession, but overall the US economy proved to be very, very resilient, right? The consumer spending was very strong, inflation remained, eased, and Federal Reserve finally shifted gears and started lowering interest rates. At the same time, one of the most impactful events was the return of President Trump to office, and which brings with it a fresh set of policy changes as well as uncertainty into the global markets. But overall, it was a remarkable year last year across asset classes. You've seen the performances of our portfolios, but equity markets, S&P 500, 20% plus returns year over year for 2 continuous years. So that's been, the highlight. China nicely rebounding, gold. One of the actually best asset classes was gold last year and all as well. So, bonds a bit more moderate, but still positive. And in the alternative side, Bitcoin stole the limelight with more than 100% returns, right? So, a lot more acceptability seen there as well. But when it comes to 2025, it is clear that we are entering into a completely new phase, a phase that will be marked by both opportunities as well as challenges. And one of the major focal points will obviously be the rollout of President Trump's policies, right? Tariffs, tax reforms, his America First strategy. All of these will create growth opportunities in some sectors while potentially also creating headwinds in others. So that's our, first trend to watch out for in 2025. The second, of course, is Federal Reserve itself, and it will remain at the center of attention because, it has to balance on one side economic growth, on the other side keep inflation in check. So inflation, again, a little bit of a limbo state where some of the Trump policies potentially can result in inflation moving higher. At the same time, China's role as a critical driver of global growth will continue to evolve as it addresses internal challenges as well as external risks. And amidst all of these uncertainties, there is still plenty of reasons to be optimistic, specifically around the technological advancements related to AI. A lot of news items there, a lot of volatility that you've seen in the markets as well. But it will be a game changer for the broader economy and investors alike. So these are the 4 key trends that we have identified for 2025 and beyond. And based on these, let's dive into 5 of our key investment themes that you can look forward to and think about in terms of your portfolio implementations as well. So number 1, obviously, is the Trump policy beneficiaries. And here we focus on the sectors that are likely to benefit under the Trump administration. And these sectors are typically the more domestic sectors, your financials, your industrials, which will likely gain as Trump puts its policy things in place. And you will see that materializing in terms of tariffs and other actions on other nations. And while the domestic economy kind of benefits from those actions as well. At the same time, when you look at the earnings distribution, it has been heavily dominated by the large cap stocks. And specifically, the Mag 7 stocks have been growing at more than 30% earnings growth over the last couple of years. That is set to change as interest rates start to come down. You will see the small cap starting to, get earnings momentum being picked up there as well. So 2024, we will move from single digits of earnings growth to 12.9% of earnings growth in the small cap sector. At the same time, as you move forward, 25, 26, you see the earnings growth massively jumping to 30+% as well. So these are a few key changes that you will observe, which will basically mean that in terms of momentum, where you can see a lot more action is in these segments. And when it comes to financial and industrials, these are sectors that have already started moving. You can see over the course of Trump's ascendancy to the presidency, financial and industrials have been the best performing asset classes and sectors in the equity market. And similarly, the small caps have also started to rise as their earnings, season kicks in and more of those earnings gets released and all as well. While on the mega cap and large cap names, the earnings are a bit more mixed this time. So if you move on to the next slide, our core equity 100 portfolio is really strategically designed to drive all of these long-term growth opportunities. So you don't really need to tactically take exposure to these sectors and segments of the market. We have a lot of these embedded within our portfolio as strategic allocations. So whether it is the industrials or financials from a sector standpoint, or when it comes to the small cap sectors, you can see that our portfolio has larger allocations to the mid caps and the small caps compared to the benchmark, which has it at 3.8%. We'll come to the China part in the next slide as well in theme two, but you can see here as well that we have slightly higher exposure to China at 9.7% compared to benchmark global equity portfolio. The benchmark is basically an all country world index. So having exposure across the world. And that has around 2.5% of China exposure. So we do have a higher exposure to China. And what you're seeing right now is that producing itself in terms of or resulting in a greater performance from our equity portfolios as well. So if you move on to theme two, this is basically on Chinese equities. We are calling for a contrarian tactical opportunity here. And if you look at China more from a valuation standpoint, obviously this has been the case for a fairly long period of time. Over the last 4 odd years, China has been trading at a massive discount to the US equity markets. So a PE range of 10 versus 20 plus for the US markets. But more than that, there is also a lot of policy support that is coming in from the Chinese government and the broader PBOC as well. And that has really led to a significant move up into the Chinese equity market since September 2024, since a lot of these policy support pledges were put into action. So you can see that the Chinese market is up 25%, very strong start to the year as well. It started to slightly dip, but then again in the last couple of weeks, you've seen a massive rally kicking in into the Chinese equity market. There is a lot of buzz coming in from China, a lot of technological advancements. Aman talked about DeepSeek. That has been creating a lot of noise in the market, but more importantly, a lot of Chinese companies are now also adopting and collaborating with DeepSeek to focus on their next big AI opportunities. So you see that happening with Alibaba, you see that happening with some of these other single names as well, and again that resulting in a significant uptick in those stocks as well. So in terms of how you can take exposure, again, if you go on to the next slide, we have our own flagship China growth portfolio. This is built in partnership with Crane Shares, and they are the experts when it comes to investing into China. And this portfolio is really geared to invest into the new China economy, right? So this is investing into consumers, it is investing into green energy, so electric vehicles, stuff like that is something that you will see a lot more. Semiconductors, battery storage. These are themes that are emerging within the Chinese economy. There is high-tech innovation. There is also a lot of healthcare spends. So you can see with the aging population in China, there is a lot of focus on healthcare, etc. And and other than that, of course, there is this consumerism that is going to happen as part of China's shift from a manufacturing-based economy to a more consumption-led economy. And that basically, again, comes to the IT and services part as well. And these are all areas that we have incorporated in the construction of our China growth portfolio, the performance of which, again, Aman had highlighted previously. So if you're looking at a more diverse exposure to China, but with a kind of a focus on the evolving new economy, then this might be a portfolio that you can consider rather than trying to dabble with individual stocks, which can be highly volatile. Going on to theme three, on the bond side, while the returns have been moderate so far, the reality is the rates have started to move back up again, and that presents a pretty great opportunity when it comes to forward-looking returns as well. So usually when the starting yield is high, the 5-year forward returns from the bond markets is also very, very high. So right now, both investment grade and high yield the starting yields are north of 5 and 6%. So if you are investing into the bonds at this juncture, from a forward 5-year return perspective, you can look forward to a pretty good growth rate coming into bonds, and with a slightly, or I would say even pretty much lower risk perspective compared to the equity markets, right? Which have at this juncture a much higher, I would say, risk component attached to them purely from a valuation standpoint and all as well. So if you go on to the next slide, if you look at our own income portfolios, you can see that the current yields of the income portfolios are pretty high. And that combined with the fact that, if you look at SSBs, T-bills, fixed deposits, rates are very, very low, getting almost a 3% above, kicker with these income portfolios and with a very defensive positioning. So if you go on to the next slide, the average credit rating of our income portfolios is in the A range. So that's considered really, really, good credit quality. And the duration component is also managed to be in the 5-year range, which means that if interest rates are too sensitive, our portfolios will still be, a lot more stable. If you move on to the next slide, coming on to the REIT side, this is where I think Aman was also mentioning a lot of the REIT returns have been impacted by the movements in the macroeconomic landscape. And mainly on the US Treasury side, you can see that there is an inverse correlation. So as US Treasury yields move higher, the returns of REITs start to move down. And this has been the case over the last 6 odd months. Prior to that, when there was this announcement that rate cuts are going to happen, you saw that early on, if you see the left-hand part of the chart, the REIT starting to rally as interest rates started to come off. But now the interest rates have stabilized and moved up a bit. And that's the reason the REITs market has become also a little bit more volatile. But as we move forward, yes, there is inflationary aspects that could kick in again. But the reality is we are still on a downward path overall moving forward, which means that from a REIT sector perspective, as interest rates stabilize, you can expect the REITs to bounce back over the course of the next year. So if you move on to the next slide, more importantly, from a fundamental standpoint as well, REITs are very well valued. The fundamentals are super strong, whether it comes to your rental reversions that you can see the data over here, very, very strong rental reversions across different subsegments of REITs. But also the occupancy levels are really, really high. So you're seeing very, very strong fundamentals when it comes to the individual REIT subsegments. And on top of that, if you go on to the next slide, the valuations are also super attractive. So the price to book ratio of the REITs market is 0.85x. And this again is one of the historical lows, right? So if you are entering at this juncture, you're entering at a pretty low valuation level, which means that if there is a bounce back, you can expect that bounce back to be pretty meaningful. And again, I mean, everyone knows about this, but just highlighting again the kind of extra yield that you're generating from Singapore REITs compared to your government bonds and treasuries, etc. and all, it is more than 4% extra yield that you're able to generate through the S-REIT segment. All right, so let's quickly move on to theme 4. So, having said all of these different aspects, whether it is the equity markets, the bonds, the REITs, the reality is we need to diversify. And there is no greater concentration risk that has happened in the market than what we are witnessing right now. And that brings us to what kind of diversifications can we look forward to, which basically means things like gold, as well as other portfolio hedges could be aspects that you can look to build into your 60-40 kind of an allocation. And when it comes to gold itself, it has been super strong in terms of returns, even in the wake of the US dollar being super strong. So usually gold and US dollar are inversely correlated. But even in the wake of very strong US dollar, there were plenty of geopolitical concerns which led to gold remaining strong for the last year. And as interest rates start to come off, and if the US dollar starts to fall a bit, you can expect that upside to continue on gold as well as a safe haven asset amidst all these geopolitical uncertainties as well. On top of that, there is all the EMs that are also buying into gold. So you're seeing increasing allocation to gold from not just the developed economies, but also the more emerging economies as well. So yeah, I mean, like, this is important. The other ways is the downside protected portfolio that we talked about previously as well. You could use that as a portfolio hedge in combination with gold and bond. So if you try to construct a portfolio, these could be components that you can add on to get a more diversified exposure to the market and address some of those concentration risks. The last theme quickly is our private markets access. So this is something that we have not touched upon a lot in our previous segments and all. But it is important to understand that there is this evolution of private assets. And these private assets, if you are able to get exposure to them, they can really unlock opportunities which goes beyond what you see in the public markets. And again, it also benefits you from a diversification standpoint. The chart over here is, a little bit more complicated, but easy way to understand is on the left-hand side, on the vertical axis is the returns, and on the horizontal axis is the volatility or risk. So the higher up you go, the better the return, the lower the volatility, the better, right? So what you can see is the arrow marks where you have a standard 60-40 portfolio, or 40-60 portfolio or 80-20 portfolio. When you add alternatives, which is the private assets, into these portfolio mixes, the direction in which the portfolio moves from a risk return standpoint is always positive, in the sense that the return increases while the risk decreases, which is what you want when it comes to additional asset classes. And this is very strong because when it comes to these alternatives, if you add them in a way which complements your overall asset allocation, that can meaningfully alter the risk return metrics that you have, as well as smoothen your journey of investing too. Now, obviously, from an access standpoint, private assets are limited in terms of access to retail clients. But if you are an accredited investor, or if you believe you can become an accredited investor on our platform, then we have plenty of options available on the syfe platform as well. So if you go on to the next slide, we have currently couple of strategies that are available on the syfe platform. So on one side, there are private credit funds. These are funds that invest into private companies and lend money to them. And the reason these exist is a lot of banks have found it very difficult to lend to private companies, post GFC, etc., all of those. So there has been institutionalization of the private credit market, and there is a lot of I would say opportunities available in this segment, and very high returns, as you can see, in the range of 9 to 12%. Similarly, we do have bond funds as well, and these are target return funds where you hold the bonds to maturity and you can target a yield which is much higher than what we talked about on the investment grade and the high yield side, which was around 5-6%. So you can look at, again, 9% returns from this segment of strategies as well. So if you are interested in these kind of portfolio strategies, do reach out to the advisory team, and they'll be happy to help you out in terms of understanding these in more detail. With that, I'm conscious of the time. I will take a pause and open it up to Q&A. Aman, over to you.
Thanks, Ritesh. So a reminder, folks, that on the screen you have a QR code, same link as the poll at the start of the webinar. Any questions that you'd like us to run through, we're going to take on as many as we can, and for those of you we don't get to respond to, we'll put together a summary response as well, so not to worry. Okay. So perhaps I can take the first one there, Ritesh. So for the income plus preserve and enhance portfolios, the distribution yields are so close, and therefore how would I pick between them? What's the most appropriate income portfolio? What should be our considerations? So the first thing with this, I'd remind folks. So distribution yield is one aspect of the total return of these portfolios. The preserve and enhance portfolios, by design, have slightly different risks and therefore yield and return trade-offs. Essentially, this is a question of overall credit quality, and both of these portfolios are of good credit quality, A minus and A plus on average, but it's around just some of those smaller tilts that have been taken. To give you an example, that from a high yield perspective, our preserve portfolio will have around 1% high yield bonds, maybe 15% or so in emerging markets. Whereas for enhanced, that'll be more like 4% for high yield. And for emerging market, that's around 20%. So these slight differences in the tilts and the credit quality that we're taking on in as part of these portfolios powered by PIMCO, what that will lead to is that slight difference in risk and return profiles there. There's a lot more detail on these two portfolios though on our website if you want to drill into the details. Those two tilts were just two examples there. The biggest difference is high yield and emerging markets for these two portfolios. Ritesh, is there anything you'd like to add for that particular question?
Yeah, no, I think you covered it, but mainly from an objective standpoint, when you're trying to choose, I guess, it depends on what you're trying to achieve. If you're looking for, again, a little more smoother ride, then I would say preserve is a better option given it has smaller allocations to emerging markets and high yield versus the enhanced, which has slightly higher allocations. So if you're looking at, to have a more stable format in terms of your risk return, then I think the preserve is a better option with higher quality investment grade kind of bond exposures versus enhance tries to enhance both return, but also enhances slightly the risk, even though, as Aman mentioned, the risk is just slightly higher, not too high.
Thanks, Ritesh. Let's take a look at a few more questions. Okay, whilst we're on income, before we come back to some outlook questions, whilst we're on the income portfolio, the second question here, the portfolio handled by portfolio managers, how do they compare to exchange traded funds? Do they really outperform the market? Now, I can understand why you might be asking this question. The outperformance is quite sizable. A quick reminder in terms of our investment process, we're always looking holistically at all the options available to us. And that includes looking across exposures, across geography, sectors, but also cost efficiency. I can tell you that yes, this portfolio does outperform those equivalent exchange traded funds or funds that are covering the broader bond index. You can look those up. We have the details on our website as well. But if they were not, we would be implementing this portfolio in a different way. I think it's something that maybe isn't as intuitive. But in the fixed income space, this active aspect, that deep expertise that PIMCO have really does deliver that extra value for us, and that is why we've chosen them as a partner on this product. I've looked at ETFs in this same space that would be giving you the return of approximately 1.4, 1.3% that we saw in our reference charts versus the kind of the much higher numbers that we can generate from the income plus portfolios.
Yeah, and I guess just to add on to that, look, I mean, overall, our intent is to give you a globally diversified portfolio. At the same time, we are not active managers, so our intent is not to tell you we are great stock pickers or we can predict where the markets are going. We rely on core investment fundamentals when it comes to how the portfolios are designed. And when it comes to long-term returns, the reality is the long-term returns are almost 90% driven by the asset allocation process, and only 90+%, I would say, by the asset allocation process, and only say 4 or 5% due to market timing or security selection. So it's very important to understand that we focus on asset allocation, and that is geared with a lot of research that we have done over the course of multiple years. And what we do on top of a basic global exposure are these factor exposures that we add onto these portfolios as well. And these are factors that are proven to drive long-term performance. So, whether it comes to value ETF, value-based factors, small caps, These are all exposures that we have taken and implemented to drive that long-term outperformance eventually. And similarly, when it comes to income portfolios, we have been conscious that, like, on the core portfolios, while we are using ETFs, on income portfolios, we are using active funds. And the reason is simple. I mean, like, in different objectives of clients, we want to make sure that we give you the best building blocks. So when it comes to long-term growth-oriented portfolios, we focus on asset allocation because we know it is futile to try to time the market and security selection and trying to beat the market that way. So we rather focus on asset allocation and drive returns in a more systematic manner. While on the fixed income side, it is actually much more nuanced. There, the fixed income managers can really add a lot of value because on the ETF side, you might be very constrained in terms of how you take exposure, and the indices are bound to take, bonds which fall specifically under certain, credit domains or maturity domains, etc. and all. So they have a lot less maneuverability there. Plus, there is a lot of aspects when it comes to, your FX risks and all. So if you're not able to hedge your FX risks on these income portfolios, that can also have an impact. Plus, considerations of UCITS, because there are tax implications. So if you're buying fixed income ETFs or funds on the US market, you're exposed to 30% withholding tax. Versus in our income portfolio, we are using funds which are active, but they are the best active funds out there in the market from PIMCO. And we use their institutional share class, so the costs are really low. But at the same time, we use their UCITS ETFs, UCITS funds, which are very, very efficient from a tax standpoint as well. So all of these are considerations that we already incorporate and implement in our portfolio allocation, and we continuously evolve it and continuously rebalance it for you, meaning that you don't need to do that hard work, and we kind of manage it for you.
Thanks, Ritesh. I see that the top voted question here is more of a one that I think you'll enjoy covering. Perhaps that we can pair it. So the question is, how can we better position ourselves for the US turbulent economic performance and sentiments? I also see a question around, do you think it's time to take some profit? And I think perhaps you might enjoy taking that one on.
Yeah, sure. Look, when it comes to how the macro landscape is, things are still pretty strong. When it comes to employment numbers, when it comes to growth numbers, things are still very, very good. So it is difficult to, again, time the market, but I can understand why these questions are coming in, because markets have been on a one-way street. Like 2023, 24% up S&P 500, to 2024 as well, another 24% up. And now in 2025, we've had a decent start. It is still a positive 3% return on S&P 500, although it has been a lot more volatile. So you've started seeing a lot more volatility in the market, which brings a lot of like jitters on client sense and all. And what I would say is, again, go back to the original thought of diversification, right? Like, the markets can be turbulent. I do expect the markets to remain turbulent through the year. A lot of the equity markets are kind of like, or segments of the equity markets. I thought I saw a question around the tech stocks as well. These stocks and these sectors are priced for perfection at this juncture, meaning that a lot of returns that you see in these sectors going forward will be determined based on the forward earnings that these companies, come up with, as well as the guidance that they provide moving forward as well. So I would say, the domination of the equity market returns from the mega cap tech names is something that I'll be very careful about. So when I'm thinking about my own portfolio and positioning, I will try to diversify away from a lot of these concentrated names and into your equal weight kind of ETFs, your small caps, mid caps, as well as some of the Trump beneficiaries that we were talking about, whether it is like these industrials or financials and these specific sectors and all. Again, it is hard for individual investors to really time their movement into these individual sectors, etc. So I would still urge you to look at our diversified portfolios such as Core Equity 100, which automatically encapsulates all of these elements, and we manage it such that the concentration risks and all are addressed. But more importantly, if you are a growth investor, if you want to make your money grow over a long period of time, and that is what I think majority of our folks who have joined in today mentioned during the poll as well. And if you are that, I would say don't panic and sell off. Yeah. Because that is the worst thing that you can do. And typically, again, there are a lot of studies that have been done that when you take money off the table and then you try to retime your entry, even if you miss a few days of positive performance in the bounce backs, you might lose a lot of return in that vein. So instead of trying to time the market, try to diversify right now. In terms of strategy, if you have a lump sum investment, try to tranche your investment. Don't put all your equity investments right now, because psychologically you will not be able to take a big drawdown. So if there is a 20% market correction, you will be like, oh, I just invested a big sum and the market corrected. Even though in the long term you will be okay, in my opinion. But the reality is we are geared to short-term market movements. So I would say tranche your investments. If you're a growth investor, do DCA. We have plenty of ways to do these things on our platform as well. I myself am doing a lot of like DCA in the current juncture, rather than trying to put a lot of lump sum investments into the equity markets, and at the same time trying to diversify as well.
Thanks, Ritesh. Time in the market, not timing the market. I'll
Exactly.
let you catch your breath and take on that question at the top on gold. So how can we invest in gold via syfe? This overlaps a little bit with the diversification angle that you and I have covered this evening. Now, there's a couple of ways to do this, depending on your end objective here. If you're looking for a balanced multi-asset portfolio that includes gold as part of that allocation, then look no further than core portfolios. Outside of Equity 100, each of these invests in equities, bonds, and gold. Equity 100 is of course just equities. Now, those allocations between equities, bonds, and gold are varied between the different portfolios, but the actual sleeves, so the individual equity sleeve, the bond sleeve, and the gold sleeve, those are the same prorated like across the three bonds. I saw that was one of the other questions that had come up as well, meaning the bond component of the core balance portfolio is the same as the core growth portfolio. Now, those three portfolios have gold as a diversifying asset, and of course that contributed significantly to the 2024 performance. Now, alternatively, if you're looking to add purely gold onto one of your existing core portfolios or various managed portfolios offerings, then we do also have the syfe trade platform. This is one of the three platforms on our app, where you can enter positions into the various gold ETFs that are available there. And this is again one of the benefits of our all-in-one holistic platform. You can invest, save, and trade all in the same place. So again, depending on your objectives, you can use the broader diversified portfolios. You don't need to be worrying about how much you're allocating to gold, rebalancing, considering any other changes in your portfolios. But you also have the DIY option depending on your use case and time available. I think we've covered quite a few of these in the presentation, in particular Chinese equities, REITs. I covered the core portfolios. I see one question there on the bid ask spread when we buy and sell managed portfolios via syfe. I'll I'll cover that quickly. It's something that actually in a former life I spent a lot of time looking at and increasingly so here at syfe. Now, the bid-ask spread is actually one of the key considerations and filters when we're looking at an ETF universe, and whether it's considering taking a particular UCITS ETF or indeed any new product, the spread, the bid-ask spread, the difference between the two prices is a really important part of your overall thinking. It's essentially an implicit cost that you wouldn't necessarily know is there as part of the trading. Now, the bid ask spreads for the ETFs that we're looking at typically are a very small single digit number of basis points. That's a basis point is a percentage of a percentage point. 10,000 of them in 100%. So there's a quite tight bid ask spread essentially for the various constituents of our portfolios, and that's very much by design. If there was a constituent that had a very significant bid ask spread, that would quite often be the blocker or the filtration criteria that it doesn't pass to get into one of our portfolios. These bid ask spreads will typically be single digit basis points. That's 0.022% for example, and again with a long term growth focus, this really is like negligible in the longer term. It's one of the implicit costs we all pay as part of the investment into the market. But it's something that we keep a close eye on whenever we're doing inflows, outflows, and of course rebalances and adding in new constituents. It's a key filter or criteria in our selection of the ETF universe.
Aman, let's quickly go to the top. Let's see what are the top questions still remaining. Okay, so the core portfolios.
So I think I covered the first one. It's essentially they're the same.
Yeah.
Are you able to give a little more context or details for those looking at who we work for with private credit, perhaps, Ritesh?
Sure, absolutely. Look, the private credit market has been evolving quite a bit, and this is a segment of the market that is hot when it comes to investor interest as well. Now, the approach that Syfe will take in terms of private credit offerings on our platform is we will try to have a very curated list of private credit funds on our platform rather than being a supermarket with, tens of funds out there. And what that means is you can expect to see, one or two private credit funds which are from the large managers, right? Like, the likes of your KKR, your Carlyle, your Blackstones of the world. But these are basically, flagships and very well-known managers. So we do think, they having pretty robust track record, and they usually also invest into the upper middle market of the private credit segment. So we will have one or two offerings in that space. And then we will have a more boutique kind of manager, which will look at the lower middle market of the private credit side as well. And this is where you will see a lot more differentiation and uniqueness coming in from the Syfe offering side as well, because these are managers which again have huge track records and robust investment process, but they might not be as well known as what your Blackstone and KKR might be. At the same time, we will also offer, or we are looking to offer, a Sing dollar denominated private credit offering, because most of the private credit offerings in the market are US dollar denominated. But given that we are all Singapore dollar investors, we will try to have one offering which is in Singapore dollar. So stay tuned for the exact names of the asset managers that we'll work with. If you are an accredited investor, do reach out to us directly, and I'll be happy to take those questions one-on-one. But these are, essentially going to be available in the next 1 to 2 months.
Perhaps I can take that top question again, a world I didn't stray too far away from in former life. So given the rise of AI-driven hedge funds and high-frequency trading, the Syfe have planned to implement more active quant trading models. Now, I think something that's really key here again to emphasize our approach, especially when it comes to investing clients' money, is it's on that long-term focus, right? A disciplined, systematic approach, but with a long-term time horizon in mind. Um, Now, the strategies described here are typically very short term. I used to look at things in terms of microseconds. We're looking much longer term here, and as a result, these shorter term strategies can have wild swings in performance. Um, I think for our user base, we don't think that's something that we'd be wanting to or looking to um, expose at this stage. I think look, our approach is around long-term focus, and I think these are more towards the other end of that spectrum. Ritesh, I don't know if you want to add anything on top of that.
Yeah, no, absolutely. Look, I think as Aman mentioned, these could be, very volatile and with uncertain and very, varied returns. Even if we want to have these exposures, we will kind of like rely on, external managers who specialize in these areas, and we will bring them to you more as an accredited investor kind of user base, where you are a bit more, you have a better understanding of what you're getting into, rather than like bringing it across in our core models, because there we are very, very conscious of, drawdowns, etc. And we wouldn't want you to lose sleep over these strategies when you're investing for the long term. But having said that, I think we are always open for new ideations. If there are, other equity-oriented strategies that you are interested in, more, like nuanced strategies, whether it is specific country-wise or, other segments of the markets, we will be looking at more such opportunities, right? Like, where we can bring more value to your investments, not just on a global basis, but also, say very specific, themes, etc. So when it comes to AI, our disruptive tech portfolio, for example, already has a lot of AI-driven companies as part of the allocation. So if you're looking for AI exposure, I would start there.
Thanks, Ritesh. I think that's a nice segue, and that allows us to close and highlight that look, we're always here and available to take on this feedback or any questions you have. We're available at advisory at syfe.com. If you have any further comments, questions, feedback. Also, within this Zoom, you have various resources available to you. There's a market outlook PDF. You can access our website, and of course, you can check out our YouTube channel as well, where we go through and demystify various concepts within the investment space. With that, I'd like to thank you all very much for joining us this evening. It's been wonderful to walk you through these portfolio performance but an outlook thoughts. Again, if you have any questions or feedback, we're always available for that. Ritesh, any closing thoughts?
Thanks, Aman. Exactly as you said, please reach out to us for any further questions. In the meantime, stay invested. Yeah, I mean, the markets will remain volatile, but that's what they are. Do DCA if you're looking for equity investments. And if you can diversify, do diversify and across asset classes. If you have questions, etc., do reach out to our team. We'll be happy to assist you. Until then, happy investing.